Welcome back to the channel, guys. I'm your host, Buckning, and today we're going to talk about diversification. Is it needed? Is it not needed? Who thinks about diversification? Who doesn't like diversification? Or thinks who likes diversification? Who doesn't? But before we get into that, if you're new to the channel, welcome. This is where we put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. And if you're not new, welcome back. So we will go through the diversification of the portfolio we are building, and we'll talk about that. But before we do, let's talk about, in my opinion, the very controversial topic of diversification, because there's two sides to it, and I agree with both of them. Both sides are correct in their own right, and make sense in their own right. But you have to figure out which one is kind of best for you. The investing world is definitely figuring out what you agree with and maybe what you don't agree with. But everyone's strategy is different, a lot of different nuances when it comes to it. So diversification, what is it? Diversification is the idea or the theory or the strategy or whatever you want to think of it as, the ability to not have, as we all know the quote, all your eggs in one basket. I'm just giving my take on it, my opinion, and so you're more than welcome to leave your comments in the comment section below and discuss diversification, because sometimes it can create a heated debate for a lot of people. And so before we do that, let's talk about the two sides. So I'm going to talk about Ray Dalio on the side of diversification, and then I'm going to use Charlie Munger as the other, as not diversifying in a lot of ways, where these two people have opposite ideologies when it comes to diversification and what that means. And yes, I've heard all the quotes. I'm sure every investor has. Oh, I do enough research that I can protect myself from, I don't have to diversify because I know the company so well. Like, just stop. We know it's a Warren Buffett quote, and it doesn't help at all the situation. So Ray Dalio talks about diversification, and he has this video out on YouTube. You can search it up. It's called The Holy Grail. He talks about it in his books as well, that diversification reduces the risk of the portfolio. When you have stocks or securities or whatever it is diversified in different sectors of the market, so that may be consumer staples, consumer discretionaries, healthcare, finances, and so on and so forth, you reduce the risk of your portfolio if anything were to happen. Okay. And you can you can retain the returns, maintain the returns that you are expected to have or expected to want. And so he talks about that in that video, and how diversification in different sectors reduces the risk. But risk is another interesting thing. Risk has to be defined in your own right. Is risk volatility? Because it's definitely not volatility. Volatility just talks about the ups and downs of an industry, sector, the stock price, whatever it may be. The risk is a permanent loss, taking a downturn in the market for your portfolio and confirming those losses by selling that position. So it's very permanent in that sense. So risk is different for everybody. And so you just have to figure out what risk level you have and what falls in the category of risk. Okay, is risk you having everything in one basket? Is risk having everything in one sector? Is risk, losing money or losing value in your positions? So Ray Dalio takes the side of diversification is the holy grail, reduces risk, and you can still get good returns, expected returns that you are hoping for. He's all for it, diversification, but they have to be uncorrelated. And what does that mean? What do I mean by uncorrelated, or what does he mean by uncorrelated? It means sectors positions that are really not connected in certain ways. So in different sectors. So for example, bank stocks will benefit from a rise of interest rates. They will definitely benefit from that because that's how they make money. However, in real estate stocks, so like REITs and things like that, they benefit when the interest rate is down, because then they can borrow more money to purchase more buildings, to increase cash flow in that sense, to grow their business. And so you can see those two different things. Banks banks like the increase of interest rates, and real estate companies like the lowering, the decrease of interest rates. And so they act in opposite ways, which are uncorrelated, essentially, except for when the whole market is taking a downturn, like in 2008, everything took a hit. Okay. And so that's it. That goes for tech as well. As you can see, last year in 2020, tech stocks went through the roof. Airline stocks went down into the ground. Okay. Airline stocks. And so totally different sectors in a lot of ways. Well, I don't know if they're totally different sectors, but totally different industries, but totally reacted differently to what happened in 2020. Okay. So that is diversification. Diversification is the strategy to own different sectors in your portfolio to reduce the amount of risk in the event of a downturn, and specifically in sectors. Okay. If you have, like, for example, like my portfolio that we're building right now, you'll see that the majority of the portfolio is in the finance sector, which is a lot of banks. And we'll talk about that as well. So that is the one side. The second side we talk about is not being diversified. Charlie Munger and Warren Buffett are very research or analyze specific companies and really understand how the business operates, and they're just a really good company. For example, and everyone knows this quote is they protect themselves. Diversification is protect oneself from ignorance, but then there's people that say, oh, I do enough research to protect myself from ignorance. And that's like a Warren Buffett quote or something. And people like to throw that out in the comment section. I see it quite a bit. And it's just, does that really make you somebody that is not prone to risk? Probably not. I mean, for example, I think Charlie Munger in one of his videos talked about the 3 stocks he would own, and that's all he would ever own, which was Berkshire Hathaway, Berkshire, whatever you want to say it, Costco, and another one. And those 3 he'd be totally fine with that. And they talk about, if you're not somebody who likes, who's not very good at stock picking or very good at company picking, then the S&P 500 is just fine for somebody who's looking for average returns. Not all of us, including myself, are looking for massive gains. I'm not trying to beat the market. I'm trying to stay within the average of the market. And I would like average market returns because that still compounds to quite a significant amount of money. And it puts a lot of stress on people when they start trying to own quite a bit of companies in their portfolio. And so, when it comes to not diversifying and just having belief in the sector you're in or belief in the companies that you believe in, it makes it easier, and you're okay with the risk. I'm always told, don't play a game you're not willing to lose. Don't play in a game you're not willing to lose, especially when it comes to your money, or your future, or your life savings, or financial freedom. Okay. And so for me, I'll go through the portfolio with you and show you the sectors that I'm in, but really think like diversification can be the smoother ride to higher gains, and a less diversified, concentrated portfolio can have a lot of volatility. So it'll be down one week and up the next and down again the next thing, and it's not very smooth. It's quite a bumpy roller coaster. But when it comes to diversification, you have a smoother ride. And sorry, I don't have any images to kind of picture it for you, but just having, there's people that are really good at picking companies and really good at finding undervalued companies like Warren Buffett and Charlie Munger. I'm not one of those guys. I'm definitely not that person. I'm okay with average returns, market returns, and continue to put money in there. I know this is a dividend portfolio, but these are companies I believe in, and I'm not in all the sectors. And so I'm okay if it drops. I'm still, my time horizon is still quite a far out. I'm looking for that growth anyways. I'm not looking for exponential growth, which I think sometimes people mistake what I do with wanting higher returns, but I'm not too concerned about it. And so hopefully that makes sense. Okay. And so diversification and more concentrated portfolios are quite a topic. However, you have to figure that out for yourself. Are you okay with average returns? Are you expecting more? Because if you're expecting more, then go ahead and pick, those companies. There's EFTs out there for you if you're looking for average returns. But just make sure that if you're buying EFTs, or sorry, ETFs, not ETFs, exchange traded funds, if you don't know what that is, make sure that the holdings in there are not overlapping maybe with another ETF, because then now you're just increasing your weight in that company. And so then your diversification kind of goes out the window in that sense. And being over diversified is not a good thing either. Okay. So hopefully that makes sense, but there's really no right or wrong answer when it comes to diversification. You really have to figure that out on your own and figure out what your investment goal is. Because not everyone invests, not a single person invests the exact same way. There are people that believe in different things, believe in different companies, different fundamentals, and so on and so forth. You have to figure out what kind of investor you want to be. And it should probably just be something that will help you go to sleep at night. Don't try to do something that will keep you up every single night. Investing is not supposed to be that taxing, hopefully. But if you're not someone who likes the risk of up and down all the time, then S&P 500 index fund, or something that gives you enough diversification where you don't have to think about it, and it'll just do average market returns, which is still good. 6 to 7% per year is still good. Okay. So we will go to trackyourdividends.com. I have the diversification wheel pulled up for the portfolio that we're building. And these are the sectors that we're in. Okay. So as you can see, the majority of it is in the financial sector, which holds about 52.8% of the portfolio. Now, a lot of people ask, why are you so invested in the banks? I believe in the banks. I 100% believe in the banks, and they continue to perform regardless of all the noise that's going on with decentralization and banks going out of business and hates on the banks and so on and so forth. But I truly believe in the banks. They continue to create a profit. They continue to evolve in ways that they should, to continue to be competitive and relevant to the marketplace. And they continue to pay dividends. And that's why I like the financial sector. Everything we do revolves around money. And whether it's buying a stock, whether it's selling a stock, whether it's buying something, whether it's your job, everybody has a bank. A job's not going to pay you in cash unless it's under the table. They typically deposit a check into your bank account somewhere. And so I heavily have 52.8% of the portfolio in banks. Okay. The next one is technology. Now I have 22% in tech, which is Qualcomm and Cisco Systems Inc. For these companies, they're good businesses. I truly believe in these tech companies. Now, some people might be thinking, why don't you have Apple? Why don't you have Tesla? Don't forget, this is just the portfolio we're building on the channel. So technology is Qualcomm and Cisco. Communication services, so telecommunications, so cell phone towers, service providers for your handheld device. We have TELUS and BCE, which is Bell Canada. I don't have Rogers in there. Those are the two of the three major players in Canada. And I just have two. Okay. And so 17.5% is in telecommunications. Do I see growth in these companies? I see slow growth. There's been quite a tight grip when it comes to telecommunications in Canada. But I do see competition. I mean, who was it that Rogers bought Shaw out? And so that leaves three players in the communication services game when it comes to Canada. And so I own two of them, and it totals of 17.5%. The last one is a consumer staple, not a consumer discretionary, consumer staple, which is food, which is things that people need. So Loblaws is a grocery chain that owns like your superstores, your Shoppers Drug Marts. I think they own TNT in like Calgary or Edmonton and all around across Canada. And people need that. 7.7% is in consumer staples, not consumer discretionary. Consumer discretionary would be like your restaurant chains. In that. So discretionary. So do you need it? Do you not need it? Or do you want it? Do you not want it? And consumer staple is an absolute need. People need to be buying water need to be buying food for themselves to sustain life. Okay. Now I do have a relatively small position in this, but I'd like to increase that position over time. And those are the 4 sectors that I'm in. There's a total of like 13 different sectors, which include like healthcare, consumer discretionary, and so on and so forth. Okay. So those are your sectors. Industry wise, you can see 6.1 Manulife is insurance, Cisco Systems Inc. is communication equipment, grocery store, Loblaws, semiconductors, Qualcomm, telecom services, same thing. And then banks, diversified in that sense, all 4. I don't have all 5 banks. I just have 4 and 100% in equity. Okay. I don't have any bonds because I don't like bonds. The return on bonds is just not good. And I'm okay with not having it. Okay. Some people do. If you're older, a good rule of thumb is you take 100 minus your age, and that's the percentage you should have. So let's say 100 minus 30 is 70, 30. So 30% bonds, 70% equities is a good ratio. But I don't bother with bonds. As you can see, this is my investing style. It's going to be different for everybody. So just take that into factor as well. Okay. Next thing is total holdings. My largest holding is in Royal Bank. My smallest is in Manulife. Total sectors 4, largest sector financial services. Love it. And smallest sector is consumer defensive, also known as consumer staples at 7.7%. We have 10 dividend payers, highest yield of 5.4% from Bell Canada, and Royal Bank coming in at $39. Okay, so do you diversify or do you not diversify? It is totally up to you. It is not a decision someone can tell you to do. There is lots of opinions, and you should always go do your research and figure out what's right for you and figure out what your goal is and work towards that. Everyone has their opinion, and people will try to put their opinions on you and force you to think the way they do and invest the way they do. But sometimes it just doesn't work out that way. I mean, if you're a person that just wants to buy one stock, like an Apple stock or a Google stock, and you're okay with that, then all the power to you. But I don't have the right to say whether diversification is good or bad. That's for you to figure out for yourself. But those are the 2 sides when it comes to diversification and really how you should diversify. If you want to figure out how to diversify, there's plenty of videos out there that talk about diversification. And there's plenty of videos that help you understand analysis of companies and being an owner of that company and figuring out, do you actually want to own a piece of that company and not just the stock? Okay. Another thing to ask yourself is risk. What is risk to you? Is risk volatility? Is risk value? Okay. So diversification can become a really stretched out topic, but I've kind of run out of time to talk about it. So hopefully this video kind of makes sense, but I just wanted to get it out there and really talk about it. And so if you did enjoy the video, leave a like, comment, and subscribe. Totally optional, but totally free. Really helps the channel grow. And give me any feedback, like feedback that actually helps, not like I'm going to insult you and then give you feedback. Okay. So other than that, guys, have a great week, and we'll see you in the next one. Bye.